Fiscal Policy and the Job Guarantee by William Mitchell and Warren Mosler. Fiscal Policy and the Job Guarantee, the cost of the job guarantee, budget deficits, and financial markets. The job guarantee operates as a built-in stabilizer, and as such avoids most of the criticisms of Keynesian fiscal activism and possible problems associated with Lucas-type behavior. Footnote 11. Okun, 1981, devoted merely a footnote to supply-side economics, which he termed an analysis of the determination of changes in the production function. From a policy perspective, he says that their position cannot be taken seriously. Nordhaus, 1983, commenting on the divided state of macroeconomics in the 1970s, said, quote, "Out of the ashes of defeat rises a new phalanx of competing theories, a ragtag collection of discarded ideas from the past, as well as unproved fancies for the future. The new phalanx of theorists, monetarists, supply-siders, rational expectations, deficits, deficitists, gold bugs, and constitutionalists have contributed little to resolving the dilemmas of economic policy. They only provide diversion from the real task of economic policy making." End quote. End footnote. However, the critics of the job guarantee approach also point to financial constraints that they allege would arise from higher budget deficits. For example, Sloan and Wooden, 1993, referring to the so-called costs of a public service employment schemes, say that these costs have to be financed in some way, raising the specter of crowding out and choking off job creation in the private sector. End quote. In this section, we argue that this viewpoint is unfounded. The willingness of government to allow the budget deficit to increase and decrease as is necessary to maintain full employment is essential to the viability of the job guarantee policy. Footnote 12. Watts and Mitchell, 2001, estimate the costs of a job guarantee program to achieve 2% unemployment in Australia. Using a comprehensive revenue outlay framework, they estimate for 1999 that the net budgetary costs lie between $5.5 and $6.4 billion for a full year. End footnote. As we outlined above, under a price rule job guarantee policy, market forces determine the size of government spending, the quantity associated with the price rule. As the private sector sends its workers to the job guarantee pool to obtain the funds desired in aggregate by the private sector to pay taxes and net save. Despite this logic, the use of budget deficits remains controversial since the Nehru era has been marked, in part, by a vigorous pursuit of budget surpluses. Ray, 1998, provides an excellent account of the destructive consequences of this policy. We now carefully deconstruct the financial arguments to show where the negative connotations of budget deficits fail to meet the test of logic and empirical scrutiny. One of the most damaging analogies in economics is the alleged equivalence between the household budget and the government budget. This has been captured by the Government Budget Constraint Framework, GBC, Ott and Ott, 1965. However, a household, the user of the currency, must finance its spending ex ante, whereas the government, the issuer of the currency, spends first and never has to worry about financing. The government is the source of the funds the private sector requires to pay its taxes and to net save, including the need to maintain transaction balances. The GBC is used by orthodox economists to analyze the three alleged forms of public finance. 1. Raising taxes. 2. Selling interest-bearing government debt to the private sector, bonds. And 3. issuing non-interest-bearing high-powered money, money creation. Various scenarios are constructed to show that either deficits are inflationary if financed by high-powered money, debt monetization, or squeeze private sector spending if financed by debt issue. It should be noted that the GBC is just an ex-post accounting identity, whereas orthodox economists claim it to be an ex-ante financial constraint on government spending. There are many flaws in this argument. For our purposes, we note 4. First, as issuer of the currency, government spending is inherently constrained by what is offered for sale, not available funds. Second, bonds issues are best thought of as following spending, not preceding it, as they function to support interest rates rather than to provide funding. Third, as a consequence, the concept of debt monetization, money creation to finance spending, is not a distinction from the general case of government spending. Fourth, there is no inevitable link between monetary growth and inflation. We examine each of these flaws starting with the money inflation myth.